following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back to another edition of Volatility Views. This is, of course, the program where we dive deep into the world of volatility and volatility trading. My name is Mark Longo from the OptionsInsider.com, as well as ye old Options Insider Radio Network, the ever-expanding Options Insider Radio Network. We just added a new show, the Options News Rundown. So look for that coming to our website or to iTunes or to whatever audio player of choice you use to listen to this program. And of course, I am not alone on the old Volatility Views panel, not by a long shot. I am joined by my co-hosts, my partners in crime, if you will, starting off with the man who's probably preparing to dig out from snow as we speak, none other than Don Schlesinger from the Volatility Exchange. Don, welcome back to the show, sir.
Hi, everybody. Hard to believe for at least the third or fourth weekend in a row that we've got yet another prediction for snow over the weekend. A little bit warmer, so hopefully mixed in with some rain, and not going to be a very big event, but seems like every time we get ready to do the show, we're hunkering down for another round of snow. It's been quite a month of February.
We got at least a few inches here in Chicago. I don't know how much, but I know they were plowing out the streets here this morning. So we got at least, I'd say, somewhere between 3 and 6.
At least you're not St. Louis or Kansas. I saw some really tough Midwest winter storms for these past couple of days there.
Well, Alex Jacobson would tell you that you guys get it worse than us.
Yes.
It's been quite a reversal in recent years, huh?
Yeah, your boy, in between accolades for you, he talks about how New York weather is worse than Chicago.
His two favorite topics of conversation.
It really is. All it is Don weather, Don weather, Don weather.
Alex and I go back a long time. We did some good things together, and he's a great guy. I have a lot of respect for him, and it's always fun when I get to see him on either trips out to Chicago or at industry panel discussions or whatever. He's one of the really good guys of the industry.
Yeah.
And listeners may recognize that tinny voice and that sound of a slinky as representing none other than good old Mark Sebastian from OptionPit.com. Mr. Sebastian, how are things in your neck of the woods?
Oh, pretty good. I'm feeling pretty good about one certain market call I made last night after the bell. That if you're listening to this after the option block, which is what you should be doing, you know what I'm relishing in.
Yes, I believe you pontificated that we would see some green on the board today and perhaps a commensurate sell-off in the old VIX cash, and we are seeing both of those as we're recording the show, I should say, today in the mid-session on Friday. Most of the major indices, all of them are actually up about 0.5% on the day, and the VIX cash selling off to the downside, down about 0.75 point or so. So, Mr. Sebastian, looks like you hit one. Nice little single to right field there. Well done, sir.
Thank you.
What are all these noises coming from your thing?
Sorry.
What is going on?
I'm a college man. I won't need my high school diploma anymore. I am the smart. I am the smart. I am the smart. I
How long have you had that one queued up?
S-M-R-T. I mean S-M-A-R-T.
I was just I was popping that one up because I was about to brag about how smart I was, and then so anytime I'm going to do that, I play that. That's my new sound effect.
I was going to assume
for when I'm bragging.
I just assume you have that one queued up and ready to go at all times.
Oh, of course.
All right, and with the team assembled, we're going to dive right into our vol review in 1 second. But before we do that, if you like what we talk about on this show, if you like listening to Mark Sebastian, and hey, who doesn't, and myself, and of course a number of others, and you're interested in how volatility intersects with unusual options activity, then you may be interested in joining us on March 27th at the CBOE. We're going to be doing our first ever premier Options Insider event. We're going to talk about all sorts of unusual activity, in particular how to find it, and once you find it, what you can actually do with it in your own options trading. We got a lot of great guests. We're even going to throw in a floor tour of the CBOE, see the VIX pit, see the SPX pit. Hurry up and see them before they're gone. And then a lot of great stuff going on, a great half-day seminar going on over there at the CBOE. So join us if you're going to be in Chicago on March 27th. You can surf on over to theoptionsinsider.com/events to find out more and see how you could register there. A lot of great stuff going on that day, so it should be fun. And now we're going to roll right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. And if you're just joining us for the first time, this is, of course, the portion of the show where we look back on the week's worth of activity from a volatility trading perspective. And if you've listened to our last few episodes, then you know that we've been talking about, what's going to give us some vol? What's going to give us some vol? We didn't really see much in the future that could potentially give us a little bit of a pop, a little bit of life to this market. And of course, this week we did see some of that, at least a pop from a vol perspective. Of course, I have a feeling we're going to get into how that pop disassociates from what's actually been going on in the market itself. So perhaps we'll start there. Senor Sebastian, what caught your eye this week your eye in this week's worth of volatility action?
You know, this has been the most volatile week of the year so far.
All 6 of them or so.
Right. Well, I'm just saying is that this is the first, we talked about that January is basically watching paint dry, and February started out, the first couple days of February we saw some action. Now we're actually starting to see some actual realized volatility. And, the VIX at 14 and change is overpriced. But if we continue to move at, 0.75% to 1% a day, it's not, insanely overpriced anymore. If we're moving, 0.8%, then, a 14.5 VIX is about fair, right? So I think that we've definitely seen an uptick in realized volatility in the S&Ps. And I think where you're really going to see that uptick, and this is going to be a layup to Don, is NASDAQ, where the NDX has been, to say the NDX has been range bound is the understatement of the year. We had this weird thing where Apple continues to do nothing, but the rest of the index is flying around up. And so you're actually seeing the components of the index gain in value as such that Apple is losing some of its grip, and the index is going to be allowed to start moving around again on its own devices, net of that jerky company that too many people are obsessed with, that has factories where they have to put nets outside of windows so people don't jump out of the windows.
Yeah, obviously, Mark, we have seen an uptick both in realized volatility of S&P and NASDAQ. Last week's numbers had hit extremely low levels for realized volatility. We had gotten below 8 on S&P. We're at about 9.25 now for trailing 21-day historical volatility. And NASDAQ was below 12 at about 11.6 and now is in the 13 handle, about 13.3 or 4. So clearly there has been an uptick not only in implieds but in realized as well. Then you get a day like today, and they start to come a little closer to each other, because on a day like today, with the indices up about 0.7%, that is about a 10 or 11% volatility on an annualized basis. So for S&P at least, slightly higher than the 21-day average. It depends on what number will drop out from the far end. But you could conceivably, on a day like this, see realized volatility actually gain a little bit, whereas the VIX and implieds start to come down almost a full point, not only on the weekend effect, but because the rising market usually comes along with a falling VIX and falling VIX futures for the negative correlation between the two. So the spread between the two might actually narrow some more as VIX comes in and implieds, as realized actually perhaps tick up a little bit.
You know, Don, I could write about the weekend effect every week or once a week for 10 years, and there would still be people confused by it. It's incredible, but you know, the big interesting thing with volatility is that just because the public sees implied vols moving up or down doesn't mean that implied vols are actually moving. Market makers see volatility as implied volatility as a moving target. It's one of the reasons why realized volatility can sometimes be considered a better gauge of where volatility actually is than implied.
Well, certainly we've talked about this many times, and we may actually have a few questions on it today. There is that ongoing debate, if you will, as to what predicts future volatility better. And the one thing that's clear, as you've just mentioned, is realized volatility is telling you what the actual volatility of the market has been. Always use my analogy of the thermometer. If you want to know the temperature, you go out and you hang a thermometer and you read what it says. Implieds are the sentiment, what options traders are pricing various options on the S&P and using a particular feeling, if you will. Not that it's disconnected from historical. I think there's a great connection between the two, but you've got the concept of backward-looking and forward-looking, and exactly what realized volatility represents, a formula of movement, and what implied represents a sentiment, and also priced in with a risk premium that we've talked about many times in the past.
We might have a couple of firsts on this show. I'll have to go back and search through the archives to make sure, but I think this is the first time perhaps in the history of the show that we've said VIX is not fairly priced, but at least somewhat close to it from a realized versus implied perspective. That might indeed be a first for this program in its history. So that's interesting in and of itself, one. And then number two, Mark, I like what you said there. I mean, we have hit on the weekend effect a number of times in the past. You just did a quick overview of it again. Perhaps down the road, maybe in an upcoming show, when we have a mailbag again, we'll sit down and just hit all the points of the weekend effect and lay it out all for our listeners one final time in one epic fell swoop, so no one can say they're confused of this ever again. And whenever anyone asks, we'll just point to this episode and say, there you go. Here is the definitive resource on the weekend effect and how it hits options and how it hits the VIX, and therefore you can never be confused about this again. So that's another potential thing to discuss on an upcoming show, I think. So we're just full of firsts and interesting things here on this show. And speaking of things to discuss, it's time once again for, I know, one of my favorite segments of this show, and I'm sure all of you guys out there, because you keep sending in great questions. I am referring, of course, to the mailbag.
Listener mail. Listeners write in.
Mailbox.
All right, and welcome to the mailbag. This is, of course, where you, the listener, get your chance to chime in and sound off on the Volatility Views program. And if you'd like to join your fellow listeners and have your voice heard on an upcoming episode of Volatility Views, just surf on over to theoptionsinsider.com. You can post a comment. You can use that comment system to send us an email. You can, of course, as a lot of you do, find us on Twitter or on Facebook, or, of course, just shoot us an email directly. Questions@theoptionsinsider.com. Just do me a favor and put question for Volatility Views in the subject line so we know which show you are referring to. And we're going to kick things off with a question from Tim Ross, and he says, I've heard the host refer to gamma scalping, in quotes, before on the program. What does that mean, and should I be doing that in my own trading account? And you are correct, Tim. If you listen to this show for any length of time, we have discussed gamma scalping in various capacities on this show in the past. I'm not sure if we've ever actually sat down and explained what that is. So if we haven't, or if you're new to the show, we'll do a quick overview of that right now. We've talked about the Greeks on this show, many other shows on the Options Insider Radio Network. Remember, typically gamma scalping refers to being long premium, so therefore you're going to be long deltas, long gamma. What does that mean? As the underlying rallies, your delta is going to increase. You're going to get longer deltas, essentially longer shares of the underlying in your portfolio. What do a lot of professional options traders do with that? When they get long, they find a good point at which to scalp, aka to sell those extra deltas out of their portfolio. The whole idea behind it being that you think the underlying is going to retrace and you're going to be able to buy those shares back at a much cheaper price. It's the way that most professionals, quite frankly, defend their long premium positions against time decay while they're waiting for whatever it is they're waiting for, the underlying move to happen, the volatility move to happen, whatever the case may be. They use these little scalps in between as a way to offset some of the time decay. It's not really a huge profit driver. It's more of a defensive thing. Once in a while, if you get a really good day vacillating back and forth, you can make some money gamma scalping. But again, you sell those deltas up high, the underlying may retrace during the day, drop back below where it opened, drop back even farther below that. All of a sudden, you're getting short deltas now, and now you're going to come back and buy those back. So there is essentially gamma scalping in a nutshell. You're using that to sell high, buy low, offset your long deltas and short deltas, and hopefully by doing that, you will be able to offset at least some, and if you're lucky, maybe all, of your time decay. Don, I'm guessing you didn't gamma scalp too much because you were never long gamma. So maybe you hedged a little bit of short gamma every now and then, but I'm guessing you weren't doing too much scalping.
I did just about the most diametrically opposed activity
How did I know?
What you just described that could possibly be, because as listeners will understand, when you are long gamma or long volatility, the way to make money is to take advantage of intraday movements that perhaps give you the potential to lock in some profits before the market may reverse and they become illusory and you lose them. And so when you're on the short side, anytime you would make such a trade, you're actually locking in losses rather than profits, and you're always very hesitant to do that. You always want to look at it as, well, you know, I'm showing a negative mark here, but if I wait a little longer, maybe it'll turn around and reverse itself. I don't want to take action too soon, lock in that loss, and regret what I've done. So you have this ongoing tendency to fight making a trade, and you want to sit on your hands as long as you possibly can. And that's the way, we talked about it before, people with diametrically opposed positions can actually both be making money at the same time. A short premium seller might do nothing all day long. Market might move around and close exactly where it opened, and he'll collect the day's worth of theta for not having made any trades at all. A nimble gamma scalper who's long that same position, maybe a straddle, might get 2 or 3 or more opportunities during the day when there is some movement to do that scalping that Mark just described and take very small profits and be happy with his day. And you've got long and short on opposite sides of the same trade, still capable of making money at the end of the day.
Yeah, Don, you're definitely on the dark side of that options, or should I say, of that gamma scalping perspective, where you're waiting and waiting and holding on, hoping you don't have to hedge and lock in some losses. So two polar opposite sides to the same coin. Great question, Tim. I'm glad we could clear that up for you. Next up, we have a question from Nitin Gulati. I hope I'm pronouncing that right. He is a big fan of this show, so I hope I don't butcher his name. And he wrote in a great question here. He says, Mark, Volatility Views is the best educational show in the world of options trading and education. No one could have assembled such a great team of hosts. Well, Nitin, first off, thank you for that. Flattery works every time. And of course, you're a man of distinguished taste to appreciate a show like this. So, and we do endeavor on this network to try to find unique set of hosts for each show. And we certainly think we've done that with Volatility Views. It's certainly been a fun show to do, and we're glad you have enjoyed the show as well, and hopefully learned a little bit. Nitin goes on to write, Don often refers to vol of vol in his comments, but how can this serve as a useful tool in the retail trader's arsenal? This is my favorite part of the question. He goes on to kind of contradict himself a little bit. He says, on second thought, we often use vol cones to understand how realized vol is at lower levels on some individual names, in addition to indexes. But if implied is also priced lower further out, doesn't that mean that the market is pricing muted moves in the future? How would a trader differentiate if he wants Vega only, as gamma might not be that cheap as you want it to be? So a lot of questions entailed in there, some perhaps contradicting each other, but an interesting question nonetheless. And Don, since he asked you directly, I'll give you your first chance, as I know you're probably quite anxious to get a crack at this one.
Well, we probably need to answer it in pieces because, with all due respect, he goes on in several different directions, and there's really more than one question here. So at least I'm going to begin at the beginning, and then perhaps all of us will take a stab at the different parts. But the part that says that I often refer to vol of vol, and how can that serve as a useful tool in the trader's arsenal, the easiest way to look at this is to simply realize that when we say vol of vol, we're simply referring to the fact that volatility as an asset or as a number that we're trading or tracking has a volatility the same as any underlying asset. So if you just leave aside for one moment that we're actually talking about the commodity called volatility, it displays, when it moves around, a volatility the same as anything displays a volatility, whether it's a stock, a FX, a bond, or whatever the case may be. And so if you are trading this particular asset, forget for a minute that we're even calling it volatility, it will display a volatility of its own, and it's important to know where that is, what levels are normal and historically high or low, especially for options traders, because where you have implied volatility of options, that's a very big component in any trade to know whether you are trading at historical high levels, low levels, average levels, etc. Even if you're trading an instrument that doesn't get affected by an implied volatility, such as a futures contract or a straight line contract, you still are very mindful of volatility simply because you want to know how much tendency there's going to be for that instrument to move. Something with a very high volatility can move sharply and with large movements up or down all over the place. Something with a lower volatility, not as much. So the fact that we call it vol of vol, kind of put that second vol out of your mind and just consider that, yep, we're trading volatility, of course, but that it, like any asset, has a volatility of its own, and you should always be mindful of the volatility of any product that you're trading for the reasons I've just mentioned, whether it be soy or corn or gold or this thing we call volatility.
Yes, and Don, you're absolutely correct. The true utility to that for a retail trader, even if you can't really trade vol of vol, is to understand the levels you're getting into and out of trades at. So you know if you're putting on a trade at this implied level, how that correlates to historical and realized vol, because if you're buying some absurdly inflated level of implied that the realized has never even come close to, looking at the two of them will give you some indication of that, and vice versa. If you're selling a very low level and the realized has typically been much higher, that'll give you some indication of at least what range you're trading in. If you're completely ignorant of that, you're almost flying blind in many respects from a trading perspective. The second part of your question is interesting as well. Of course, Mark, do you want to touch on the first part before we go on to the second part?
No. I think you guys covered it pretty
The second
well
part
there.
here, he goes on to invoke Don's favorite thing in the world, vol cones. He says, how can we use vol cones to understand realized vol? And he mentions if implied is also priced lower further out. Doesn't that mean that the market is pricing in muted moves in the future? And of course, you are correct. If implied vol is low, then the market is indeed pricing in muted moves in the future. And how do you use vol cones? Well, that's exactly what we were just referring to. The vol cones show you where the realized levels have been historically, so you can compare the level of your trade to the historical level. I think the really interesting part of your question, and I'm sure Mark will have something to say about this third part, is how would a trader differentiate if he wants Vega only, as gamma may not be that cheap, or as cheap, I should say, as you want it to be? And that's an interesting question. We get some variation on that quite a bit here at the Options Insider. And there's a lot of different ways you can do that. I really don't know the level of your sophistication in terms of option and trading pure Vega perspective. I mean, the simple low-hanging fruit answer to that, and maybe not the cheapest, but one of the cheaper ways to do it without the added layers of complexity, is simply to focus first off on some longer-dated options. Therefore, by simple definition of the Greeks, you're going to get more Vega, less gamma, so you don't have to worry as much. That doesn't fall into the cheaper realm. They're going to be more expensive, but that does let you focus on the Vega. And if you get a little more sophisticated from there, you can start doing some things to offset some of that Vega cost and that premium. Of course, legging into vertical spreads in that farther off month will reduce some of that net outlay. And if you're really sophisticated and you're really focused on gamma and hedging some of that gamma, we've talked quite a bit about time spreads on this program. You can, of course, buy the longer dated month, sell the shorter dated month. That will hedge and indeed, and perhaps this may be the worrying part for you, get you short gamma, and you have to really understand short gamma before you trade it, which is why I was hesitant to bring that up. But if you feel sophisticated enough, then time spreads are the ideal tool for hedging your gamma exposure and making it muted, or perhaps even getting short gamma if you want to offset some of your time decay. Now, Mr. Sebastian, I know you're a big proponent of long time spreads these days. You have anything you want to share here with Mr. Nitin?
Yeah, that's kind of the big thing is that you're right. Just because vol is cheap doesn't mean that just because vol is low, it can stay low for a very, very long time. But the problem is it can be very difficult to be long. It can be very difficult to own options without and have long volatility exposure without having long gamma. And I always argue that time spreads long Vega, but not really long volatility. And so when you're deciding what you want to do is you have to say, okay, do I want to be long realized volatility, long gamma? Do I want to be long implied volatility, which is, a calendar or a VIX future or some trade of that type? Or do I want to be long both, which is a straddle, and which is a long or a longer dated straddle? And you really need to kind of come to a conclusion for yourself as to kind of what you want to do. And that's really how those things are put together.
Go ahead, Don.
It's one of the trickiest things about trading calendar spreads because of this distinction that you've just made. If you buy a longer dated option, sell a nearer dated one, and look at the graph, the risk profile, it doesn't look terribly dissimilar from a short straddle. It's kind of an inverted V, only the arms are curved rather than straight because the expirations are not the same. And yet, because you own the longer dated option, which has a higher Vega, if implied volatility goes up across the board, the same on both, you actually make money with such a position. So when you're rooting for what you want, it's a very contradictory type of feeling, because when you're short a straddle or you're long a calendar spread, you really don't want great movement in the underlying. If you dislocate too far left or right from center, you wind up losing money, and that's the realized volatility that Mark just mentioned. By the same token, if implied volatility goes higher, even if you don't move at all, then the position actually makes money. So somehow or other, you're rooting for the market not to move very much, and while that's happening, for implied volatility to go higher. And that's a tough thing to pull off. They don't often go in tandem like that. So that's part of the challenges of managing a calendar
That's one of the
spread.
reasons why I hesitate to recommend that strategy on this show or to a particular person who writes in, because to me, calendar spreads have always been where the rubber meets the road for a lot of retail traders, and managing that delicate balance between long Vega and short Gamma and how they offset and the very often contradictory viewpoints you have to have when looking at both of those and how to manage them appropriately and manage that balance is a tricky thing to do. And so we'll talk about verticals all day here on the show and other things that I know a lot of people can easily manage, but some of the other aspects of managing calendars, I'm leery to recommend those to people until I really know that they can handle that balance of it. But if you feel you're up to the challenge, Mr. Nitin, then that might be that's the obvious course of action for you. And if not, I encourage you to surf on over to sites like ours, or perhaps contact guys like Mark who can walk you through it personally, how to best manage a calendar spread. Next up, we have a comment actually from South Bay Trader 1. He says, looking forward to the weekly fix from your show. Good humor in a world of darkness. Well, there we go. I guess we're his weekly fix for humor. He says, when's the next stand-up tour? So there we go. I guess people appreciate our lighthearted approach to volatility. He says, I enjoyed the Vol series discussing, I always call him Talib, you call him Talib, we'll mix and match, Talib's strategies. Interesting to hear competing viewpoints. More on Vol futures versus cash would be appreciated. He obviously likes that part of the show. He also asks, he also goes on to say, assignment risk and possible spread strategies for mitigating cash outlays along with margin thoughts would be great too. That, South Bay, actually kind of falls outside of the purview of this show a little bit. We don't really get into assignment risk and spread strategies. But fortunately for you, if you are interested in that, we just did a show on our Options Bootcamp program. We just did an episode called Assignment and Exercise Risk, and it gets into all of that stuff in great detail. So if you're not subscribing to that show already, surf on over to iTunes or Stitcher or your podcast player of choice and subscribe to our Options Bootcamp program, and we'll get into that in extraordinary detail on that episode there. So thanks for your comment, South Bay. We're glad you liked the show. Hopefully we can keep giving you your weekly dose of humor. Next up, we have a question from T-Bill1, and he says, what do you guys think of the recent spike in VIX? Seems to be way out of whack with actual movement of the S&P. See, I listen. And so you certainly seem to have been listening to our recent shows, T-Bill, because we do talk about that quite a bit. And we're glad to have a dedicated listener writing in. And of course, you touched on this at the top of the show. As I said, this is perhaps the first time in at least recent memory that we've said that the VIX cash and volatility levels overall are relatively fairly priced relative to the fact that we have some actual realized vol for the first time in a long time on this show to discuss. So you have been listening. We appreciate that. But actually, we're looking a little much, or should I say, we're looking much more fairly priced than we have been in the past. Mark or Don, anything to add here for Mr. T-Bill?
No, I think that you've hit the nail on the head. That you've got to take every VIX quote unquote spike into consideration. The thing you've got to remember is that they'll put it in percentage terms to make it sound big, but you're really just looking at ticks. The VIX is more like a batting average than it is a stock price, and yet it's presented as stock price, which is the silliest, dumbest thing on the planet. So, your VIX spike is my vol went up 1%.
That's true. It is all contextual, as we like to say on this show, time and again. All right, next up, we have a hardcore question from Mr. Umberto Toli, another listener coming out of Italy, maybe, Don. That's a lot of good listeners over in that part of the world. He says, do you feel the current options tax treatments put forth in Congress, particularly the covered call tax treatment, will stifle volume and or drive exchange volume into the OTC realm? If so, what impact do you feel this would have on overall S&P and NASDAQ volatility? This is indeed a very hardcore inside baseball question, but what he is referring to, listeners, if you're not familiar with it, there have been a number of proposals put forth in Congress recently to adjust the way options are taxed on a fundamental level. I think the covered call one he's referring to is perhaps particularly egregious and shocking. I'll just give you a quick synopsis of it here. Essentially, there's been a proposal put forth in Congress here in the U.S., and for our international listeners, maybe this will affect you too, because what happens here tends to spread over borders. someone, a very, let's say, less than options savvy congressman, has put forward a bill where it would treat options taxes in a very bizarre way. If you, like right now, if you own an underlying and write a call against it, it's essentially treated as a certain type of position from a tax perspective, and not until the option is exercised and the underlying is called away do you really have any taxable implications of that. The other, what is being proposed right now is absurd, and maybe Mark and Don, you're not aware of this, so this will be the first time you're hearing this, but there's a proposal out there that essentially would, even if you write a worthless 5 delta call against an underlying position, a call that has no chance of coming in the money, that position, that underlying will now be viewed as having essentially been sold from a tax perspective. So the instant you write a call, no matter how worthless it is, that underlying is now essentially treated as sold. Exactly. That is the most ridiculous thing I've ever heard. Anyone who has any sort of knowledge of options.
What congressman put that in? There's no way that's going to get out of
hopefully not, but there are a lot of... I don't have the name off the top of my head, but I know it's been attached to some other, as a rider, some other big bills that have a chance of passing. So people are kind of concerned about this. And of course, what impact will that have? Well, talking to any broker in this space, they'll tell you that 60-70% of their business is some sort of income generation, typically covered call writing. So if that passes, that business is going to dry up. So what happens there, that's going to essentially, either we'll have two things. We'll have very thin markets because no one is trading. So we'll see these very erratic spikes involved that have really no underlying movement to associate with them. Or we might have just a very stifled and muted market because no one's out there trading. Either way, I don't think the impact is going to be very beneficial. But it's a ridiculous bill. Hopefully Mark is right. It has no chance of passing.
There's no way that this is up there with the voodoo that with transaction taxes and stuff like that.
Yeah, fortunately, or hopefully you're right. Hopefully it is just crazy voodoo because it's one of these things that sounds so.
Find me this congressman. Find me out this.
I have it somewhere. I'll have to send it to you after the show.
There may be the dumbest person on the planet.
What concerns me about it is it's so crazy that it sounds like just the kind of thing that would pass. Because that's the kind of thing they would write down there because it makes so little sense. And if it was a little bit closer to reality...
It's a tax increase, so it'll never make it.
All right, so thank you for that question, Umberto. Good to see you're following along with our domestic stuff here, even from overseas. Next up, Mark, you'll like this one. We have a question from E.T. Moore 16. He says, I'm thinking about dispersion trading, perhaps Apple versus the Qs, maybe Google or Amazon too. How much do you think I need in my account to do it? We get these questions all the time. How much do I need to trade this? How much do I need to trade that? And I guess there's really two answers to these type of questions. One is the bare bones, how much you need to do it. And the answer to that is pretty much very little. You can just trade straddles on either. You can do that with probably $10,000 in an account, maybe even less. But the other answer is how much do you need to do to really do it effectively? And that is probably the more challenging part of that question. And that, of course, is a much higher number, because you need to actually be able to manage your stake and manage your trades effectively. With $10,000, you can maybe afford to do a couple of dispersion trades in Apple, and then if you miss out, you're pretty much done. But if you have a little more money, you can manage your stake much more effectively. Mark, I'm sure you get this question a lot from your mentees. What do you typically tell them in the account range for this sort of thing?
You've got to have a well into portfolio margin.
So that pretty much puts the bar at $100,000 minimum, because that's the typical bar.
But I would never. Yeah, I mean, I think you're looking at a couple $100,000, because you need to be able to sell straddles, buy straddles, and buy and sell stock. So you're looking at basically you need like a professional market maker type account. So you need like probably at least $250,000 with decent 2-to-1 or 3-to-1
People always think
haircut.
about how much do I need to buy the options. They forget how much they need to set aside for margin to sell the options, and that's a huge amount. And that's what Mark's really referring to. The benefits of portfolio margin really come into play there.
Yeah, you need to be able to sell straddles, so basically it's ridiculous for a Reg T account. And really, I wouldn't do it unless I had enough money to be short a decent amount of straddles, long a decent amount of straddles, and trade all of the stock around it.
So there you go, listeners. North of 100,000 is really our bare bones minimum to do it effectively.
Let's say north of $250,000.
To do it effectively, we're talking about. I mean, you could always try your hand at it with a couple of thousand in your account, but it's probably not going to work out too well. And the margin requirement just to sell that other straddle or whatever you're doing to capture the dispersion.
And a put spread versus a call spread is not a dispersion trade.
There you go. Good stuff. Don, anything to add to this, or?
No, I mean, I defer to your actual knowledge of the trading part of it, but, without the ability to have cross margining and to
Right.
have offsets, you're really looking at the individual costs of owning and then again the rather steep requirements for selling options short, and obviously that adds up in a hurry.
Yeah, that's the one thing we always remind people. They always think, how much do I need to buy in options? They don't think how much goes into the other side of it, the margin required for selling short straddles and things like that. And usually that's substantial. So keep that in mind when you're thinking about margin going forward. Hopefully we didn't burst your bubble, ET Moore. Perhaps it's a good thing we did, because you're thinking you can do this effectively with just a few $1,000s. Then you're probably chasing a fool's errand. All right, next up we have a question from Finn Tompkins, and he says, what do the Vol Views crew think of the underperformance of the emerging markets VIX relative to the actual VIX? Is tail risk just overpriced in the U.S., or is it a bargain in the emerging markets? If you're not familiar with what he's talking about, this is, of course, the emerging markets ETF VIX that the SIBO disseminates. There was an article recently in Barron's comparing and contrasting the performance of the two, and it shows that the U.S. VIX versus the emerging markets VIX, the U.S. VIX is substantially higher in pretty much all aspects. And of course, comparing and contrasting those is very much an apples to oranges comparison. The U.S. domestic actual VIX, whatever you want to call it, is a legitimate tradable product. It has futures around it, has options around it. There's a legitimate consensus. We've talked many times on this program about the extraordinary universe of ETPs that also exist on the VIX. There's numerous tradable products that exist in and around the VIX to keep it at these levels and to make it these levels much more defined and practical, whereas the emerging markets ETF VIX, it's more of a theoretical type product at this point. So comparing and contrasting the two, I know it makes for some good copy, and a lot of people like that story on our site, but it really is very much an apples to oranges comparison. Senior Sebastian, Mr. Don, you guys agree, disagree with that?
Agree 100%. And yeah, so you're really not looking at the same thing, which is interesting. And the interesting thing is that EM vol itself is always crazy overpriced. So, that's kind of an interesting, it was an interesting study.
Yes, I guess the other thing I would add to that too really quickly is that he mentions tail risk. And of course, the new quote-unquote VIX takes into account the skew, but VIX is not really a measure of tail risk in and of itself. You have to look a little bit deeper for that. So just looking at VIX and saying, oh, tail risk is overpriced, it's a little bit another apples and oranges type comparison. But still a good question, Mr. Finn Tompkins. I'm sure a lot of our listeners were curious about that one. All right, and unfortunately, that's all the time we have for the mailbag this week. Of course, I want to thank all of you who wrote in. If not, then surf on over to theoptionsinsider.com or shoot us an email, questions@theoptionsinsider.com, or find us on Twitter or Facebook, and you too can be part of our glorious mailbag. But now we have to roll on to our final segment, the Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and welcome to our final segment of the show, the Crystal Ball segment. This is, of course, where we peer deep into the turbulent and murky waters of the future from a volatility and volatility trading perspective. And as actually kind of contrary to what we predicted last week, we actually got a little bit of a spike in vol, which is great for us. Something to talk about this week. And of course, as you mentioned at the top of the show, a commensurate move in realized vol. The disparity between the two is finally starting to close up a little bit, so we don't have to keep beating that same drum over and over and over. Huge disparity implied versus realized. So now the question put to us going forward is, will this continue? Is this realized vol real, to put it in simple terms, or is it just a flash in the pan and we're going to go back to the massive disparities we've seen over the past few months? Mr. Don, why don't you go first?
Well, we have the luxury on a very, very short-term basis of seeing the market responding today and continuing an upward trend after a few, I won't say scary days, but at least days where we are reminded that the market can, in fact, move in two directions. Hadn't seen too much of the downside for most of this year. So we're at a point right now where perhaps, as we're seeing in implied volatilities as measured by the VIX, any possible short-term fears have quickly been abated for a little while, and the VIX is down, if not a full point today, about 0.8 of a point. Realized volatility, again, on a slight uptick, and that can potentially continue regardless of direction, because even if we have a return to some big up moves, that can actually factor in as volatility irrespective of direction. And the negative correlation that's very strong between implied volatility and equity price movement is not quite as strong for realized volatility, which often can and does move in the same direction. If you get a really big up move, you can get an uptick in realized volatility as well. So I might take a stab at saying that we might continue to see somewhat of an uptick or increase on realized volatility, but what happens to implied, I always kind of connect that with what actual price movement is. If we turn down again, you're likely to see VIX and implieds go higher. If this movement that would prompt realized to go up is to the upside, then you're going to see a contraction in implied volatilities once again.
Mr. Sebastian, do you concur from the VIX perspective?
Yeah, I kind of do. Do I think that we're gonna? I agree. I think we've definitely seen an increase in realized volatility. I don't know that the VIX is going to be settling. I think 13 to 14 is probably going to be in between 13 and 15. It's going to be where the VIX hangs out. These spikes above 16, I don't think we're going to be able to. I've seen for us to the ability to justify yet, but I think that maybe we're done, at least for a couple of weeks, having some seeing the VIX with a 12 handle. That said, we've got Italian elections over the weekend, and that could absolutely, if things go the way people want, that could absolutely crush things on Monday for VIX.
Yes, good old Italian elections, always the indicator I look to. Our friend Alberto, I'm sure, would be paying close attention to those. All right, thank you for that. And that is all the time we have for our Crystal Ball segment. And as always, before we go, I like to check in with my cohorts here, my co-hosts, my partners in crime, to see what they have cooking for you, the listeners of Volatility Views. We'll start with you, Senor Sebastian. What is cooking over in the land of optionpit.com?
On March 13th, I'm going to be presenting a webinar with Andrew, so you get both of us, and where it's going to be 6 o'clock in the evening, and it's going to be interpreting data to pick directional trades using options. It's going to be a really good webinar combining kind of some of the tools from Andrew's days at Acumen with basically all the option knowledge that Andrew and I have. It should be a really fun one. Go to optionpit.com/events to register.
There you have it, listeners. Head on over there if you'd like to hear both Mark and Andrew. If this one show was not enough for you and you need more.
Yeah.
All right. And Mr. Don, what is coming up in the land of Volex and Volex.us?
It's been a pretty quiet week. Not a whole lot that's new. We had a wonderful guest on the show last week, Scott Maydell, and I think we may have mentioned that his paper is available not only on the Options Insider Radio Network and on your site, but we have put it up as the most recent addition to the Volatility Library. It's called Capturing the Volatility Premium Through Call Overwriting. Those of you who listened to the show last week will know what we're talking about. If not, then you're still catching up. It was a wonderful show, and the paper is available in the Volatility Library for those of you who'd like to see all of the statistics, the charts, all of the research behind our discussion. I found that to be a fascinating show. I thought it was very well done from our guest point of view, and listeners who'd like to read more about it can find the paper there as well as on the other sites that we mentioned.
Yes, that was a great show, and I encourage all of our listeners to surf on over to volex.us and check out that volatility library. You can find that paper and many more things over there. You guys are creating quite the vol archive for our listeners to enjoy. And before we go, since we are talking about events, and Mark was just talking about webinars, I should mention that I will be next week doing a webinar with our friends over at Market Taker Mentoring, discussing the top 5 mistakes of options traders. It's a webinar I've done many times over the years, and I got requested, or I should say it was requested, that I bring that one back because it's such a popular one. So I'm going to do it again next week. You can find the link over at Market Taker Mentoring or on theoptionsinsider.com if you want to find and learn about, if you want to surf on over and find a few tips and tricks to improve your overall options trading. And coming up for the truly hardcore amongst you, I should say, if you're going to be in the Chicago area on March 27th, then join us at the CBOE for our Unusual Activity Summit. It's our first ever premier event at the Options Insider. We're going to do a lot of great stuff, floor tour, all kinds of great goodies, great panel sessions, great experts, including Mark from this show and the guys from Market Taker and the guys from Trade Alert who are true experts in how to find unusual activity. A lot of great stuff going on there. You can surf on over to theoptionsinsider.com/events. Like I said, it's our first ever premium and premier event, only $99 for all of that great stuff. I wish we could do it for free, but unfortunately there are costs whenever you put together an event like this, so we're trying to keep it as low as possible so as many of you can get in the door and check this out. The space is limited, only about 100 people can fit in, so hopefully all you guys can get a chance, if you're going to be in the Chicago area, to join us for our Unusual Activity Forum again on March 27th. Surf on over to theoptionsinsider.com/events if you'd like more information or to register for that. And that is going to do it for us here on the Volatility Views show. But before we go, all of us here on the Vol Views panel want to thank all of you out there in the listening audience, including all of you who wrote in from around the world to ask such great questions in the mailbag this week. Keep it up. We love hearing from you guys, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.